This presentation is for Chapter 23, Statement of Cash Flows. In this chapter, we will describe the usefulness and format of the statement of cash flows. We will also prepare a simple statement of cash flows in this presentation and direct you to another video for the preparation of 2 additional years in Excel. In the second part of the presentation, we will discuss the differences in the direct and indirect methods of calculating net cash flows from operating activities. We will also discuss some special problems associated with cash flow statements and how to use a worksheet to prepare the statement of cash flows. In this first objective, we will describe the usefulness and format of the statement of cash flows. The primary purpose of the statement of cash flows is to provide information on the sources of a company's cash and uses of cash during the period. A secondary purpose is to provide the details about the company's operating, investing, and financing activities during the year. The users of the financial statements are mostly concerned with the ability of a company to generate future cash flows, which makes the statement of cash flows very important. Both creditors and investors know that without sufficient cash flows, the company may not be able to meet its obligations timely or pay dividends. The statement of cash flows is also considered to provide information on the differences between net income and net cash flows from operations. Even though you have spent most of your college years learning accrual basis accounting, it does have its detractors. Many people feel that it relies too much on estimation and can mask underlying problems. It is more difficult to hide problems when you are using cash basis accounting. Last, the investment and financing activities, including those that don't involve cash, provide important information on changes in the long-term assets and liabilities and owner's equity accounts during the year. The cash flows of the company are divided into 3 categories: operating, investing, and financing activities. The information needed to complete the operating activities section are income statement items and changes in current assets and liabilities. The information for the investing activities come from changes in the investments and long-term assets, and financing activities are from changes in long-term liabilities and stockholders' equity accounts. This is an illustration of the sources of cash from sales of goods and from interest and dividends on investments, and the outflows to suppliers, employees, the government, lenders, and others for various expenses. This slide shows the investment and financing cash flows. Notice that cash flows, inflows, and outflows are shown separately on the statement. We don't net these amounts because that would reduce the amount of information. Generally, changes in long-term investments and other assets will provide the information needed to complete the investing section. The information to complete the financing section comes from the long-term liabilities and equity accounts. Notice that while we did include dividends received in the operating activities sections, dividends that we pay to our shareholders are included in the financing activities section as shown on this slide. Although we say that the statement of cash flows reconciles cash at the beginning and end of the period, we include with normal cash other short-term, highly liquid investments that are readily convertible to cash called cash equivalents. Generally, these investments should mature within 3 months or less so that there is no significant risk of interest rate changes. Some examples of cash equivalents include treasury bills, commercial paper, and money market funds purchased with cash that is in excess of immediate needs. As we mentioned earlier, there are 3 sections to the statement of cash flows: operating, investing, and financing. There are also 2 methods for presenting the operating activities section: the direct and the indirect methods. The FASB favors the direct method but allows the indirect method. The indirect method is used by more companies because it is generally easier for them to prepare. Also, as we have mentioned in a previous slide, The inflows and outflows of cash in the investing and financing activities sections are shown separately. They should not be netted. This slide shows the format for the statement of cash flows using the indirect method to present the cash flows from operating activities. We will study this in more detail in future slides, but the indirect method begins with net income and then is adjusted for the non-cash income and expense items on the income statement and the changes in the current assets and liabilities. After the cash flows from the investing and financing activities are added to the cash flows from operating activities, we get the net increase or decrease to cash for the period. This amount is added to the beginning balance of cash to get the ending cash balance for the period. The ending cash balance should equal the cash and cash equivalents shown on the balance sheet at the end of the period. In this objective, we will cover the steps in preparing the statement of cash flows. There are three sources of information that are used for preparing the statement of cash flows: a comparative balance sheet, which has the beginning and ending balances for the period, the income statement, or at least net income for the period, and selected transaction data. To prepare the statement of cash flows, there are three steps taken. First, we need to determine the change in cash for the period. This is the difference between the beginning and ending cash balances for the period. Next, we will determine net cash flows from operating, investing, and financing activities. To illustrate the preparation of the statement of cash flows, we will use Tax Consultants, Inc., which began business on January 1st, 2019, when it issued 60,000 shares of its $1 par value common stock for $60,000 cash. The company decided to rent its office space, furniture, and equipment for the first year of its tax consulting business. We will review the information provided in your textbook in illustrations 23.3, 23.4, and some additional information to prepare the statement for the year ended December 31st, 2019. This slide shows the sources of information that we will be using to prepare the statement. First, notice that since this is the first year of operations for tax consultants, they had no opening balances as of January 1st, 2019. At the end of the year, we see that all of their balance sheet accounts have increased. They have earned net income of $34,000 per their income statement, and we are given the additional information that they declared and paid dividends of $14,000 during the year. We will be using this information to prepare the statement of cash flows for 2019. The next step in preparing the statement of cash flows is to determine the net change in cash for the year. Per the comparative balance sheets, we see that cash increased by $49,000 in 2019. This should equal the net increase in cash that we determined in the statement of cash flows. Next, we will be determining the net cash flows from operating activities, which is the first part of the statement. It is important to remember that net income per GAAP is determined on an accrual basis. And as we mentioned in a previous slide, the statement of cash flows provides the information on the revenues and expenses on a cash basis. Therefore, we need to eliminate all of the effects on income statement transactions that do not result in an increase or decrease in cash. Whether we use the direct or indirect methods to determine the cash flows from operating income, we will be converting net income to net cash flows. Net income is based on recognized revenues minus incurred expenses. Because these amounts include accruals and deferrals, we have to identify and eliminate those non-cash amounts in order to determine net cash flow from operating activities. We are first going to illustrate how to use the indirect method to determine net cash flows from operating activities. As we stated earlier, we will be starting with net income on the income statement. However, we know that the revenues that were reported on the income statement of $125,000 contain accrued amounts that have not yet been paid. How do we know this? because there has been an increase in accounts receivable for the year of $36,000. As this slide illustrates, during the year we debited accounts receivable for the $125,000 in revenue, but we have only been paid for $89,000 so far. This means that the $36,000 of accounts receivable at the end of the year will need to be subtracted from net income to determine net cash flows from operating activities. This slide shows the reconciliation of net income of $34,000 to net cash provided by operating activities of $3,000. We subtracted the $36,000 increase in accounts receivable because those amounts have not yet been collected. We have also added $5,000 for the increase in accounts payable, which we will discuss in the next slide. The reason that we added the $5,000 increase in accounts payable is because we subtracted operating expenses of $85,000 on the income statement to arrive at the $34,000 in net income. However, we have not yet paid for all of those operating expenses at the end of the year since we have a balance in accounts payable of $5,000. After summing the increases in the accounts receivable and accounts payable, we determined that the net cash provided by operating activities for 2019 is $3,000. The third step in preparing the statement is to determine the net cash flows for the investing and financing activities. This slide shows the comparative balance sheet information and the completed statement of cash flows for 2019. Since there were no long-term assets or liabilities for 2019, there were no cash flows from investing activities. However, we did have cash flows from financing activities for 2019. There was cash provided by the sale of the common stock of $60,000, and there was cash used for the dividends of $14,000. The net amount of cash provided by financing activities was $46,000. We add this to the net cash provided by operating activities of $3,000 to get the net increase in cash of $49,000. Since there was no beginning balance in cash on January 1st, 2019, the ending cash balance as of December 31st, 2019 was $49,000. This amount reconciles to the ending cash balance on the balance sheet. This is the completed statement of cash flows for tax consultants for the year ended December 31st, 2019. I have prepared a separate video for the preparation of the statement of cash flows for tax consultants for the 2020 and 2021 years using Excel. After you have finished watching this video, please watch that one for more explanations and expanded examples of the statements as illustrated in your text. As we have seen, comparative balance sheets are needed to determine the net increases or decreases in the balance sheet accounts for the year. Additional analysis of the accounts may be needed, especially for determining the cash inflows and outflows for the investing and financing activities. Also, there is usually a need to analyze the retained earnings account in order to determine the effects of net income, dividends, and any prior period adjustments made. The statement of cash flows includes all the changes that have passed through cash or resulted in an increase or decrease in cash. There are many sources, as we will see in the next slide, of non-cash items that flow through the income statement. It is necessary to identify these because their effects have to be added to or subtracted from net income in order to determine the net cash flows from operating activities. This slide shows the type of adjustments to net income that are needed to determine the net cash flows from operating activities. On the left side are sources of additions that should be made to net income. There are many different accrual basis entries that are subtracted to determine net income, like depreciation, amortization of intangibles and bond discounts, and losses on the sale of or impairment of assets, just to name a few. None of these represent uses of cash, so they must be added back to net income. Also, decreases in current assets must be added back because they represent receipt of prior income already reported or expenses reported that were paid for in a prior period. Additionally, the increases in accounts payable, accrued liabilities, and deferred income taxes represent expenses subtracted from net income that have not yet been paid, and these must be added back. On the right side are the subtractions that should be made to net income. These include amortizations of bond premiums and investment income recorded using the equity method of accounting. There are also gains on the sale of plant assets that should be subtracted because the proceeds from sales of assets are included in the investing activities section. Any increases in current assets should be subtracted because these represent cash not yet received in the case of accounts receivable reported as revenues, or cash spent in the case of inventory or supplies that has not yet been reported in the income statement. Any decreases in accounts payable, accrued liabilities, or deferred taxes should be subtracted because these represent cash spent that was for expenses reported in prior periods. We will look at many of these specific types of adjustments again in the next part of the presentation on Chapter 23, but this is an excellent slide to review for the many different types of adjustments made to determine cash flows from operating activities. This is the end of the first part of the presentation for Chapter 23, Statement of Cash Flows.